Most crypto investors are looking in all the wrong places. You probably heard people talk about the next 100x coin or seen folks chasing the latest meme coin hype, hoping to get rich quick. But what if I told you that the real money in crypto isn't coming from price speculation or viral tokens? It's flowing through protocols that generate actual revenue day after day, regardless of market conditions. Here at House of Web3, our mission has always been to cut through the hype and give retail investors like you the knowledge that Wall Street doesn't want you to have. And today, we are deep diving into what might be crypto's most overlooked success metric: actual revenue generation and cash flow. Investors should conduct thorough research, consider their financial situation, and seek professional advice before investing. The information provided on this platform is for educational purposes only and does not constitute financial or investment advice. Please be aware of the laws and regulations applicable to your jurisdiction. I started House of Web3 precisely because I saw so many retail investors losing money chasing pumps instead of focusing on fundamentals. Our weekly revenue tracker newsletter has helped thousands of community members identify protocols with sustainable business models rather than just hype cycles. And the feedback has been incredible. People are genuinely shocked when they see the disconnect between what's popular and what's actually making money. What's actually making money isn't popular at all. Over the past month alone, the top crypto protocols generated more than $1.4 billion in fees. That's real money, not theoretical gains, not market cap estimates, but actual revenue from services people are using. And surprisingly, the biggest revenue generators aren't the names you hear about most often. Tether, for example, generated over $400 million in revenue in the last month. That's nearly $500 million alone from a single stablecoin infrastructure company. Circle's USDC bought in additional $150 million in the same period. These aren't flashy tokens that are promising some fancy tech. They are essential infrastructure making money 24/7. But it doesn't mean that you hold a token and you can participate in their revenue generating cash machines, as their tokens have no intrinsic value to the revenue. Even more interesting is what's happening with the connection between revenue and market value. There's a strange disconnect right now between how much money protocols are making and what markets think they are worth. Take Aave, one of the largest lending platforms, for example. It generated nearly $100 million in monthly revenue with a market cap multiple of only 31x at a monthly level and not even at an annual level, right? Meanwhile, many meme coins and speculative projects with zero revenue are commanding billions in market cap. It just seems absurd. This disconnect creates both risk and opportunities for retail investors like you and me. While institutional investors focus on revenue fundamentals, retail investors often chase hype and end up holding the bag when speculative assets collapse. At House of Web3, we've been running our revenue fundamental masterclass series for the last 6 months, teaching retail investors exactly how to spot the disconnect before the market corrects, like how it happened recently. Last month, we highlighted makers undervaluation in our community calls, and those who took action saw gains of over 40%, while the broader market declined. We don't give financial advice, but we do help people understand the math behind evaluations. Here's what makes this revenue story even more interesting and relevant right now. Despite recent market turbulence, from Bybit's $1.4 billion incident to Libra token controversy, infrastructure protocols have maintained steady revenue. This is the case for every single platform, whether it be meme coins on Solana fluctuating like crazy, or maybe AI agents on virtuals launching every other day. The platform processing transactions, loans, and exchanges will keep generating consistent revenue regardless of the market conditions. In this video, we're breaking down how different categories of crypto protocols generate revenue, which one offer the best value relative to their market cap, where institutional money is flowing in and why it matters, why some lesser known protocols are outperforming popular names, how the retail investors can access this information without complications, and strategically think about valuation. This isn't about finding a token that might pump tomorrow. Let's be real. Do you really want to chase schemes that are relevant for a week or two, or put your money into something that is real and compounds over a period of time? The crypto elites don't want you to know this, but there's this mysterious red button under all these videos. They call it the subscribe button. And unlike those insider signals your crypto group tries to sell you, this one actually works. Legend has it, Clicking on it grants you access to a secret society of people who understand crypto without using rocket emojis or saying, "Trust me, bro." But hey, that's just a crypto theory. Just a crypto theory. Unless you want to find out for yourself. Go ahead and hit it now. Let's start with the foundation of crypto, the layer 1 blockchain networks that everything else is built on. Without these L1s, you cannot process transactions, secure assets, or enable applications to function. But not all L1s are created equal when it comes to generating revenue. For example, Ethereum remains the revenue making king. Despite protocols like Solana and Sui often coined as Ethereum killers, this supposedly slow and expensive protocol is generating an impressive $1.72 billion in monthly revenue according to DeFi Llama. But here's what's interesting. Ethereum's market cap is around $283 billion, giving it a multiple of approximately 15x on its annual revenue. Is that justifies? Well, Ethereum has the largest developer ecosystem in the world and institutional adoption also, but that's still a premium price compared to the other revenue generating L1s. Let me tell you how. The thing is, investors do not value projects based on how popular they are. The early days of investing based on hype in the crypto space are now gone. At House of Web3, we've observed how the market has matured significantly. In fact, during our monthly crypto market structures webinars, we've been highlighting this shift over a year now, showing with actual data how valuation metrics are becoming more rational as institutional money flows in. We've seen so many traditional finance investors enter crypto now that's being treated like a stock market, where investors look beyond the story and focus on what really is a business and what is not. Now, the actual ETH competitor Solana has been on a rampage recently. And I'll tell you, despite the fact that it is cheap, faster, and a shinier tech than ETH, with 514 million in monthly revenue and $70 billion in market cap, Solana is available at a multiple of 11x to its annual revenue, showing slightly more potential than ETH. You might be thinking we are going on and on about multiples, but what does it even mean? At House of Web3, we always try to break down complex concepts in simple terms for our retail audience. When you stake your SOL tokens, you're not just earning standard staking rewards. You're actually participating in a system where network revenue is distributed back to stakers at a rate of approximately 12 times higher than what's reflected in standard market multiples. In practical terms, while Solana trades at a multiple of 11x to its annual revenue, stakers effectively receive benefits that would be equivalent to a much lower multiple because of this overvaluation or amplification, if I may. This happens because staking rewards combine both new token emissions and a portion of the network fees. This staking multiplier essentially creates a stronger economic incentive for long term holding compared to many competing networks. Now, let's look at Tron. It's generating consistent revenue of about $49 million monthly. That's about $600 million in annual revenue with a market cap of approximately 20 billion. That gives you a multiple of about 32x. While higher than some competitors, Tron has built a stable revenue pipeline through its stablecoin transaction and infrastructures, particularly in regions where banking access is limited. You might be thinking, why am I saying all this? The reason why I'm saying all this is, do you realize that when you hold a Tron or TRX token, are you actually getting any part of the revenue? The answer is sadly no. And that's what we'll cover towards the later end of this video, where you need to understand what is the use case of holding certain tokens. Not every token that you hold is equivalently helping you generate a share from the revenue that the protocol is generating. The contrast with some other major L1s is what makes this even more interesting. Cardano, with its market cap of $23.8 billion, generates significantly less revenue than peers like Solana or Tron, and yet is placed at the ninth largest crypto by market cap. The same logic goes for chains like Sui and Aptos, who are massively overvalued with revenue generating that simply hasn't caught up. For instance, Sui has generated $200,000 revenue in its lifetime and is commanding a market cap of $8.7 billion at a staggering multiple of 4,000x. Similarly, Aptos generated just $1.8 million in annual revenue while maintaining a market cap of $6.7 billion. That's a multiple of 3,700x. And then people come running to House of Web3 asking why their portfolio is at a loss. At House of Web3, we've been warning our community about these inflated valuation for months now. Our valuation red flag series has helped thousands of retail investors avoid these overpriced projects, and our community forum regularly discusses healthy valuations versus speculative ones. Who in their right minds invest in projects at 4,000x multiple? is really beyond me, unless you do not love your own money and you've gambled it all the way. What about Bitcoin? Despite its $1.7 trillion market cap, Bitcoin's fee revenue generation is relatively modest compared to smart contract platform. This is because of its primary use case as a store of value. It was never intended to be an application platform. But it also shows that investors are paying for different fundamentals rather than pure revenue generation. And this is what I spoke about earlier. For us retail investors, understanding these revenue multipliers matters because they indicate how much you are paying for actual cash flow versus apparent future potentials. This is a core principle we teach at House of Web3. Look beyond the hype and focus on real value. This is where the institutional retail divide becomes apparent for me. When you invest in a high multiple L1 or layer 1 with a minimal current revenue, you're essentially making a venture capital style bet, but without the early access and discounts that VCs receive, or even the capital that they have. Meanwhile, the other L1s with strong revenue relative to their market cap offer a much more sustainable investment profile, which you could easily tap into with just a little bit of research with the help of House of Web3. At House of Web3, we provide this research to level the playing field for the retail investors. As you evaluate layer 1 investments, pay attention to how they generate revenue, not just how popular they seem to be or how much hype they are being discussed on social media. We always emphasize looking beyond the underlying business fundamentals. Our revenue deep dive series examines one protocol each week, breaking down how exactly they make money and how sustainable the model is. For example, even though Solana looks juicy right now, Solana generates a lot of revenue through Pump.Fun, a casino for launching meme coins. But that is on a steady decline since the last 1 month and is not a long term sustainable revenue generator for Solana itself. Unless Solana finds another cash cow for its blockchain, its revenue too will be impacted as Pump.Fun alone accounts for 47% of Solana revenue, which is a huge threat to Solana. Revenue sustainability, growth trends, and reasonable multipliers are the metrics that matter most for long term value creation. This is what we at House of Web3 constantly emphasize to our community. Focus on what will last, not what's trending today. Ethereum looks solid because most of the revenue generating DeFi platforms and application layers are being built on top of Ethereum, with very few being built on top of Solana. And that is one of the reasons why I personally, despite loving Solana's tech, am more inclined towards ETH in this bull market. At House of Web3, we answer your house in crypto. We have a crypto content service where we give you a friend who you can call at any point in time to answer all your crypto doubts. Get your crypto portfolio reviewed by experts and get data-backed crypto bundles based on your risk appetite. And if you're new to crypto, we also have a Crypto for Dummies course to help you get started on crypto investing. So head over to houseofweb3.com for everything I just mentioned above. The link is in the description. While layer 1 networks form the foundation, DeFi protocols represent the financial layer built on top, the banks, exchanges, and financial services of crypto. But unlike the traditional finance experience, these protocols operate with complete transparency you might have never experienced before, allowing us to analyze exactly how much revenue they generate and where that money flows. Think about it. When you invest in a stock, like suppose you invest in JP Morgan, you're betting on their revenue models working effectively. But you get to see its actual impact every quarter when they decide to put out their earning report. Here in DeFi, you can see how much revenue they're making every single minute, completely transparent on the blockchain. With data like that, one would assume that people would invest into revenue proven utility tokens, but the FOMO and hype takes over, clouding many investors' thoughts. What immediately stands out is the data we went through is the disconnect between the popularity and the actual revenue generation between certain protocols. Let me explain this with Uniswap, one of crypto's most recognized names. With a market cap of $4.86 billion, Uniswap commands significant attention, but its revenue multiple tells a different story. The protocol generates fees, but most going to liquidity providers rather than protocol reserves or token holders. Uni token holders benefit minimally from this revenue stream that they have generated. To understand this, we need to explain Uniswap's tokenomics to you. The Uni token primarily serves as just a governance token like most of the other protocols, giving holders voting rights over protocol decisions, but it lacks a direct claim on protocol revenue.
While Uniswap collects a 0.3% fee on every transaction, the fee is distributed entirely to liquidity providers who supply assets to these pools, not to the protocol treasury or uni holders. This means that despite Uniswap processing billions in volume and generating significant fees, uni token holders receive no direct financial benefit from this activity beyond some voting rights to use the treasury for some token buybacks or other initiatives. Contrast this with Aave, which has evolved into one of the DeFi's revenue machines, generating nearly $100 million in monthly revenue or about $1 billion in annual revenue, with a market cap multiple of only 3x. Aave offers sustainability better than most of their competitors. Their revenue model has also matured with time. By focusing on sustainable lending practices and efficient capital use, they built a model that works in all market conditions, not just bull runs. After that, we have Maker with a 29.6 million in monthly revenue and a market cap of just 1.5 billion. Maker trades at a relatively modest multiple of just 5x when compared to many crypto projects that are running on the hype train. The protocol has achieved this through a diversified revenue model, generating income from stability fees, liquidations, and savings rate. After its recent governance changes and rebrand, Maker now directs more of this revenue towards Maker holders, creating a stronger alignment between protocol success and token holder benefits. So, how is Maker tokenomics different? It incorporates an improved stability fee system where the portion of the interest paid by DAI borrowers is used to buy back and burn Maker tokens from the open market. This process directly reduces the total supply of Maker over time, creating deflationary pressure that benefits all the remaining token holders, which is a great way to implement the buyback and burn strategy. After the recent endgame governance proposal, the protocol now allocates approximately 30% of all protocol revenue to these buybacks, which was around 10 to 15% earlier. So now you see they are bullish and they've increased their stance by 2x. Jupiter, though newer to the scene in comparison, has already established itself as a revenue generator on Solana, processing over 22 million in monthly and over $250 million annually. This means they command a multiple of 8x, but the catch here is that the team is actually buying back the tokens at even this multiple for the next 3 years. Every month, 50% of the revenue goes into buying the token back from the market. I'll explain in simple words what they do differently. It's actually not as complicated as you may think. Jupiter uses efficient route optimization. By aggregating the liquidity across Solana, across multiple dexes, it creates genuine value for the users while capturing a share of the transaction fees. This fundamental utility, rather than speculative hype, drives Jupiter's growing revenue base. Like many projects, when Jupiter launched this token last year, it crashed almost immediately after the initial day of trading. In fact, its all-time high still remains last year. You would expect them to simply move on to the next hype cycle, but Jupiter's team decided to address this fundamental weakness head on and change its tokenomics and issue buybacks. First, they took the big but necessary step of burning 3 billion Jupiter tokens, reducing the supply from 10 billion to 7 billion. This actually directly reduced the fully diluted valuation and increased the certainty for token holders by permanently removing 30% of all potential supply. A few weeks ago, Jupiter implemented perhaps their most significant tokenomics improvement yet, allocating a full 50% of the platform fees to buy Jupe back from the open market, with the remaining 50% invested in ecosystem growth and initiative. This revenue sharing approach is the best way to create a direct connection between the platform usage and token value, like we have explained for our other projects today. As Jupiter's volume and fees grow, so does the buyback pressure on Jupe tokens, with the protocol committed to this model for the next 3 years. Long-term holders now have a clear value accrual mechanism tied directly to Jupiter's success as a business. The comparison that I am trying to explain gets clearer when we examine Lido. As the dominant liquid staking protocol, Lido generates around $75 million in monthly fees, meaning they have almost a little shy of $1 billion a year. When it commands a market cap of just 1.2 billion, meaning its Lido token is trading at a revenue multiple of only 1.3x. But if it's not a steal, I don't know what is. But it is not. This is where you understand the nature of the token. Lido is a governance token and has very little correlation to its revenue. You see what happened there? Not only you have to track multiples, but you also have to tag the nature of the token. The most interesting evolution is perhaps with the newer DeFi protocols designed specifically for revenue sharing. Aerodrome on base and Velodrome on optimism together process about $20 million in monthly revenue with tokenomics that is meant to reward holders through vote escrow models. Let me explain this in a bit more depth. Both protocols implement what is known as V tokenomics, vote escrow tokenomics, where users lock their Aero or Velo tokens for extended periods, say up to 3 or 4 years, to receive the vested tokens. The longer you lock, obviously, the more voting power you get and the rewards you receive. The system creates a distinct advantage for long term holders. The token holders get to vote on which liquidity pools receive boosted rewards during each epoch, which is in 1 week. And a big portion of the trading fees, which is nearly 35%, are distributed directly to token holders based on their proportion of the total voting power. These protocols may not make headlines, but they are building sustainable revenue models that directly benefit token holders, exactly what retail investors should be looking for.
You know, guys, your friends might be there for you, but can they actually help you build your wealth? You ask them for advice, and suddenly it's, yeah, thanks for that. You know why I'm a little different than your regular friends? I am a crypto concierge. No, you do not need to go into the dark web or Reddit or Twitter threads to understand stuff like staking, sharding, liquidity pools. As a crypto concierge, I'll help you get onboarded onto crypto without any jargon or hassle. No guessing, no FOMO, no induced mistakes, just solid insights tailored to you. With your crypto journey, whether you're a fashionista, a hippie, over smart, germaphobe, or perpetually sarcastic, I'll be there for you. Click on the link, book a call, and let's make this simple. Because you deserve better than bad advice disguised as friendships. You deserve a concierge.
Now that I've told you what you should be wary of and what you should be looking for in your next bet, let's just discuss the most polarizing sector in crypto: NFTs and meme coins. We are focused on protocols generating substantial revenue through infrastructure and services. But this category operates on fundamentally different principles, or no fundamentals at all, I would say. These assets hit multi-billion-dollar valuations with minimal or non-existing revenue models, which makes it all the more important to understand the economy of it all. At House of Web3, we've consistently warned you and our community about the risk of having these speculative assets in your portfolio. Our meme coin risk assessment framework has helped thousands of retail investors understand exactly what they're getting into before they chase the next viral token. We believe in freedom of choice, but also in making these choices with complete information. Dogecoin screams this disconnect at a $30 billion market cap despite generating negligible protocol revenue. As the original meme coin, Doge's value derives entirely from community sentiment and brand recognition instead of cash flow. With a 37.8% decline over the last 1 month, Doge shows that you cannot simply invest into tokens with no real value. These are meant only for trading. Just compare Doge's market cap to revenue generating protocols like Maker, which generate nearly $30 million in revenue monthly, but commands a mere $1.5 billion market cap, a fraction of what Dogecoin's valuation is. To profit from these, you need to get in early. And that means before the token is even launched. Yes, there are a few exceptions, but most tokens only benefit from insiders who hold more than 90% of supply most of the time and rug pull the audience the second they can. Shiba Inu also has a $8 billion market cap built entirely on community momentum and meme status. It did try to create some utility with Shiba Swap DEX and other ecosystem components, but it's not remotely enough revenue to compare to its market cap. This creates one of the highest implied revenue multiples in the crypto ecosystem, often exceeding 5000x by any measurable income. The newer generation of meme coins show even more extreme disconnects between valuation and revenue. Yes, I'm talking about politicians who are playing with crypto. The official Trump token is still at a $3 billion market cap, despite it having no intrinsic value or any revenue generation model. It is crashing since the day three and it continues to crash, which baffles me. And the only people who continue to hold it are some insiders and some people who are left with hope about meme coins. Almost all these meme coins have seen this in the space, be it Pepe, Dog with Half, or any other infamous meme coin that I speak about. These tokens are worth nothing and get dumped with the second market sentiment turns to fear and yet collectively command over $60 billion in market cap. Meanwhile, what baffles me is Jupiter, despite processing billions of dollars in volume and generating over $22 million in monthly revenue, has a lower market cap than many zero revenue meme coins. Similarly, Compound, which facilitates billions in lending and generates substantial protocol revenue, trades at just 463 million market cap, less than Dog with Hat, which produces no measurable income. Even in the NFT infrastructure space, this valuation disconnect persists. Immutable, for example, despite building a substantial NFT infrastructure and generating revenue through transaction fees, maintains just a $1.25 billion market cap with a 39% monthly decline. Meanwhile, Pudgy Penguins, a bunch of JPEG images, commands $500 million in market cap despite crashing since the first week and now sitting at a 54% monthly decline. The Sandbox, which was going to be the holy grail of metaverse and virtual real estate, maintains a $785 million market cap, even though no one is actually using the platform. With a 40% monthly decline, Sand is another example of narrative driven valuations that collapse while institutions focus on protocols with measurable cash flow and reasonable multiples. Retail capital concentrates in high volatility, zero revenue assets. And that is funny to me. This might seem like a rant, but there clearly aren't enough people stopping investors from throwing their money into this casino. That's why we at House of Web3 have launched our Curious, the world's first crypto crash course for retail investors, an educational initiative designed to help retail investors understand the actual business models behind their investments rather than just chasing the latest hype.
You got 99 problems and don't want crypto to be one. You know what to do. You know what to do, right? You seriously know what to do, right?
Let's take a moment to reflect on what the data is actually telling us. While I was tempted to cover AI agents, AI infrastructure protocols, and sex tokens, the reality is that many of these sectors lack transparency on how much revenue they actually generate and how their token price correlate with that revenue. In the case of AI projects, particularly, it is simply too early to start tracking meaningful revenue or assign reasonable multiples. What the data does tell us clearly is that for the next 6 months, the most compelling opportunities based on revenue fundamentals are in DeFi protocols trading at reasonable multiples and established layer 1 networks with proven revenue models alongside Bitcoin as a store of value. Let's recap the key insights we've covered in the video so far. We've seen a massive gap between protocols that generate revenue and their market valuations. While Tether and Circle continue to generate hundreds of millions of dollars in monthly revenue, the tokens don't allow investors to participate in this success. Meanwhile, Aave, Maker, and Jupiter offer direct ways to benefit from protocol revenue through attractive tokenomics. So, study the token value and the token use case. Ethereum continues to dominate with about $1.7 billion in monthly revenue at a 15x multiple, while Solana offers potentially more upside at 10x multiple, but with less substantiable revenue sources. Meanwhile, newer Ethereum killers like Sui and Aptos trade at astronomical 4,000 multipliers to their minimal revenue. We identify protocols like Maker, Jupiter, and Lido that offer significantly better value than most of the market through revenue sharing mechanisms and buyback programs. Their vested tokenomics model used by Aerodome and Velodrome represents one of the most promising approaches to sustainable revenue sharing. While we also highlighted the stress in the meme coin sector, we highlighted the absurdity of meme coins and NFT projects commanding billions of dollars in market cap despite generating zero revenue, while actual revenue generating protocols trade at modest valuation. Dogecoin's 30 billion market valuation compared to Maker's $1.5 billion despite generating $30 million in monthly revenue for Maker, illustrates this disconnect perfectly. We will also dive into how institutional investors think. We've seen how institutional investors have concentrated in protocols with sustainable revenue model and reasonable multipliers, while retail capital often flows to highly high multiple speculative assets with minimal current revenue. This revenue based approach might not be as exciting as chasing the next 100x meme or jumping into the latest hype AI cycle, but the data is clear. Protocols with sustainable revenue and models trading at reasonable multipliers have demonstrated significantly better risk adjusted returns over time. At House of Web3, we believe the future of crypto investing isn't about gambling on speculation, it's about identifying protocols that deliver actual value and generate substantial revenue. The market may take time to correct these valuation disparities, but as the industry matures, revenue fundamentals will inevitably become the dominant valuation metric. For retail investors looking to position themselves for the coming months, Our analysis points to these three key strategies. Focus on DeFi protocols with clear revenue sharing mechanisms, trading at reasonable valuations. Consider established layer 1 networks with revenue proven models rather than speculative alternatives. Prioritize protocols that directly connect token value to platform success through buybacks, fee sharing, or other value accrual mechanisms. And be extremely cautious with zero revenue assets commanding high valuations, regardless of their popularity on social media. Remember, the tokenomics we highlighted earlier, their 30% revenue allocation to buyback has given a 46% increase while the broader market is declined. Do you want to guess who I'm talking about? I'm talking about Maker. Jupiter's commitment to using 50% of revenue for the token buybacks creates similar aligned incentives. These aren't coincidences, they are results of sound tokenomics that connect protocol success to token holder benefits. As the market continues to mature and institutional capital continues to flow in with greater influence, we expect the correlation between revenue generation and market valuation to strengthen significantly. The projects building sustainable business models with reasonable multipliers will likely outperform purely speculative alternatives over the medium to long term, that is 1 to 2 years. While the allure of quick gains from meme coins or speculative AI projects might be tempting, the sustainable path to building wealth in crypto comes from identifying protocols that are actually building profitable businesses with genuine utility. The projects generating $10 million dollars in monthly revenue are at 3 to 5x multipliers and are offering far better risk adjusted potential returns than those trading at 1000x multipliers to minimal revenue. At House of Web3, we'll continue tracking these revenue metrics and valuation multiples to help our community make more informed decisions because in a market driven by narratives and speculation, actual revenue generation remains the most reliable indicator of long term value creation. The choice is ultimately yours. Chase the next hype cycle with its inevitable winners and losers, or build a portfolio anchored in protocols with proven revenue models trading at reasonable multipliers. The data suggests that the latter approach will serve most investors far better in the long to medium term. And that is it from House of Web3. Thank you for listening to us. Signing off. As always, stick to fundamentals, not to hype.